Good evening, everyone. Time for another silver update. This is a 30-minute chart of silver. As I pointed out on the blog today on one of the charts I posted, that we did get below 28. The two levels I was watching, and they did seem to be confirmed, were 28.50, which was support that went back a ways, and then 28 was a low. And I expected that if we got below 28, that we would move quite rapidly down and test 26. We could bounce before we hit 26, but there really isn't any support between here and 26 and possibly even 22. So you can see this series of these fanning, rounding down trend lines. You can only draw them so far, and then the slope steepens. This one, and then it steepens again, and it gets all the way down to here, and then it steepens again, and then we've got this dramatic drop off. So we're approaching the point of a catastrophic sell-off or a spike bottom. Possibly could be one of the biggest ones we've ever seen. We could actually, in theory, we could get a spike bottom all the way down to 22 and all the way back up to 27 in one day. Things like that have happened. So if you have been keeping your powder dry, you may be presented with a sort of once-in-a-lifetime opportunity. I remember watching the market very closely back in 2008, and it was very agonizing because when it hit near $10, you thought, well, how can it go any lower? And it did, and I eventually ended up buying in the 8s somewhere. But I think I actually rounded the bottom. I think I bought some early and then bottom and then late, and that's something you can do. You can try to round it, but it's approaching the point where it's getting to be a spike. There's a lot of supply that's evaporating, so it's getting thin out there. I decided today to go out and look to see what I thought would be the best pick of all the things that I like in a coin, as far as the national mints, 1 ounce, semi-numismatic, low premium. So the one I found today, and I don't really have a lot of dry powder right now, so I probably won't be buying it, but the one I definitely like that I would be buying if I were right now, and I'll keep an eye on in the next little bit, is this Canadian Wildlife Series Moose. And this one is at Gainesville Coins. I checked the major sites. This one currently is going for $30.45. That's still $3 above spot, a little bit less than $3 above spot, but that was the best price I could find on this coin. And everywhere else it's a dollar to $1.50 more, and a lot of people are out of stock. So this is a great buy on this coin. I really like it. I think this one's got a decent chance at being a collector's coin or a semi-numismatic play. So that's my favorite right now, and want to jump over to the question of the day, and this is from SRJ19, and he says, why in the world do other countries have any gold held by the Federal Reserve or in London? Hey, Brother John, I'm piecing together the big picture like a lot of people. There have been a lot of stories recently about countries like Venezuela, India, Switzerland, Germany becoming interested in repatriating gold held outside their borders. What I don't quite understand is why so many countries have gold stored outside their country and in the hands of the Federal Reserve or in London. Is it some world banking system collateral or something, Scott? Well, yes, it is. In a sense, the world banking system currently is and has been the petrodollar. That is the standard. So it is a dollar-dominated world really ever since the end of World War II. We have a dollar-dominated world. I think that's beginning to come to an end as the United States begins to collapse from overreach, from overspending, from moral rot, from everything that tends to sink empires throughout world history. They all seem to be converging upon the United States at this time. Now, as far as the reason why they do that, you've heard the stories of the cages, whether in New York City or other places. It makes sense if you have a currency that is the world's currency that is trusted, and you have to remember that the dollar didn't become the world reserve currency because it wasn't worthy of being so. It was worthy of being so up until 1971. In fact, any country in the world could come and trade their dollars for gold at $35 an ounce. Now that is a currency that's as good as gold. And under a situation like that, you're going to have a much easier time of things balancing trade if you simply keep all the gold in one place. So if you have a giant building in New York City, for example, and every major trading country in the world which has gold backing or some kind of gold reserves to balance trade, even though they're using dollars, they can all have cages, and they can all have their gold in their cages where they can audit their gold, and then it's just a matter of rolling gold from cage to cage to balance trade, as opposed to shipping the gold overseas and doing what had been done traditionally for hundreds or thousands of years, how countries balance trade by actually exchanging the gold across their borders. So that's the reason why, and if you look at the news of what's happening with the repatriation of the gold, you can see that rather than moving towards centralization, which is what all of the, well, not all of the, but a lot of the conspiracy theorists are going to tell you, and a lot of the police state type people are going to tell you, actually the movement is in the other direction, that the center is actually beginning to fail and it's not holding, and things are spreading out to the periphery, and we're starting to see that. This takes us to the story of the night. This is Charles Hugh Smith, and he has another story about the breakdown of governments and central governments, but I decided to cover this one because it's so startling what they've done with the pensions, and this is just a really good analysis, quick mathematical analysis, something that no one can argue with, of the pensions. So he talks about how they're calculated. He says, assuming the pension funds are managed conservatively, how much money would have to be set aside to fund a single pension benefit payout of $120,000 a year and one of $60,000? The yield on a 10-year Treasury bond is less than 10%, about in line with the average dividend on stocks. That means that a conservatively managed portfolio of stocks and bonds now yields around 2%. At this rate, a pension fund would need $6 million in cash to fund a $120,000 a year cash benefit payout. The fund would need $3 million in cash to fund the $60,000 a year cash benefit payout. If the senior police officer worked 30 years, then the city would need to contribute about $200,000 a year to assemble the $6 million in cash. That's $16,700 per month for 30 years. Now this is for one employee just to amass the amount of money it would take to pay their pension. The $60,000 a year cash benefit pension would require only $8,350 to be contributed every month for 30 years. This is for public servants. Yes, the interest earned on the early years of contributions would reduce the total contributions needed to reach the $6 million total, but in the real world, cities stopped contributing to their pension funds during the good years of high returns, and pension fund assets decline in market downturns, wiping out years of gains in a few months. Assumptions and projections do not track reality. To fund 100 senior retirees and 200 less senior retirees, the city pension fund would need $1.2 billion, roughly the equivalent to 10 years of the city's entire general fund annual budget, To fund 600 retirees, the fund would need $2.4 billion. Recall that the Federal Reserve has implicitly promised to hold interest rates to near zero indefinitely. The 2% annual yield is not an aberration. It is the new normal. Those pension funds that attempt to increase their yield by gambling on stocks, derivatives, real estate, etc. will blow up when these risky markets decline, implode, as all risky markets do over time. Please do the math on your own city, county, state pension promises, the skyrocketing cost of the promised medical health care benefits, the yield pension funds can safely earn in the real world, and the total assets currently in the pension funds. There is no way to make the math work such that the pensions and benefits promised can be paid in the real world. Wishing the math were different does not make it different. We can play around with the yields and payouts, but adjusting the margins doesn't change the basic reality that the promised pensions are structurally underfunded in a 2% yield world. Important addendum. Correspondent YW provided this actuarial analysis of the numbers I projected. I have been an avid reader of yours for a while now, and your latest title, That Which is Unsustainable, contains what I think is a bit of an error. You wrote, to fund a $120,000 cash benefit pension, a pension fund would have to sock away $6 million. However, this is only true if the pensioner lives forever. All else being equal, in the real world, the accumulated capital would be slowly drawn down to pay an increasing portion of the cash benefit over time until it was exhausted. I did a simple annuity calculation of the following conditions: retirement at 55, pension paid $120,000 for 30 years with fund growth rate of 2%, came to the fund value at retirement of $2.74 million. Still a healthy and disturbing sum, but significantly under the stated value of $6 million. Thank you, YW, for this informative, insightful commentary. With this more accurate assessment, the conclusion is still staggering. To fund the senior rank public pension, the city will still need to contribute $90,000 a year, roughly equivalent to the wage of a full-time city worker, $85,000 a year average for 30 years. Since the median pay in the U.S. is about $26,000 annually, then that means the $2.74 million that must be set aside for each senior level pension is equivalent to 3 workers' entire lifetime earnings. 35 years at $26,920,000. 2 times 3, $2.76 million. Since these workers must pay taxes and fund their own retirements, we can guesstimate that the $2.74 million is equivalent to the entire net lifetime earnings of 4 workers. The standard level cash benefit defined benefit pension will require the entire net lifetime earnings of 2 workers. Even reducing the total contributions by half still leaves an impossible sum of total contributions to be made. To make the promised cash benefit payouts, every city, county must set aside the equivalent between 5 and 10 years of the entire general fund of the budget. This does not even touch on 2 other sobering realities. The number of public employees who are now in the pension pipeline who will be retiring within the next decade is exploding as the baby boomers exit the workforce, while at the same time the revenues. Both these trends further exacerbate the structural misalignment of promises made, low yields, fiscal limits on how much can be contributed annually, and the current size of the pension funds. So, an excellent mathematical analysis. I've been harping on this for a long time. The center simply cannot hold. None of this can hold. It's all going to collapse. Now, they're driving down the price of silver because they know this is going to be the case. Silver is going to snap back. We don't know when. It would be nice for the stackers if it blew through 26 and tried to find a base down around here in the low 20s. My guess is if it does touch that low, it's not going to stay there long, and we'll be back up to this price. So you're going to have to move fast if you're going to stack some silver at lower prices, because my guess is most all of the stock is going to be dried up, so you'll have to act fast. And we'll talk to you next time.